All right, well, welcome everybody. I am Marziti, and today's topic is going to be about stocks, futures, options. We're going to do a little comparison, contrast, and when to use them, how to use them, and different things like that. By the way, let me just mention here this picture was actually designed by Microsoft Copilot. It tapped into DAL-E to give a picture, so I want to give credit where credit is due. And I did ask for permission, and it gave me permission to use it. That's cool. Anyway, we've got a lot to talk about with this here. And let's see. But first, we got the disclaimer and the legal. This is a presentation that I personally have created. I am not a financial advisor. This video is for educational purposes only. I am a member of the Bullish Bears community. I am not an owner, moderator, or anything like that, and I'm not compensated in any way for doing these videos. What I have to present here may not necessarily be the opinions of anybody associated with Bullish Bears. Ultimately, you're responsible for your own trades, and you are welcome to copy this video and use it and distribute it so long as credit is given. Wow, look at all these topics we're going to cover. We are going to talk about stocks, ETFs, mutual funds. We're going to talk about some futures and some options. Now, bear in mind, this is not a how to trade it video series. This is what are they? And ultimately, why we were doing this is because we get a lot of times new members come in and they're interested in getting into trading, but they don't really know, well, what's the difference between futures and options, and which is right for me, or should I just buy stocks? Or I've heard about penny stocks; those are fantastic, and biotechs. Okay, we're going to kind of go through this so that after you view this, hopefully, you'll have a good idea of where you think you might want to be in this. So we've got a fair amount to do here. Let me start my timer here because I'm going to break this up into different sections, and I want to kind of keep them brief as best that I can. We are going to start on the what are they line. What is the difference between stocks, ETFs, mutual funds versus futures versus options? So let's just move right over here. What is a stock? A stock is a partial ownership in a company. So a company here, they want to grow and they need cash. So what they do is they offer up a portion of ownership in the company to the public that someone can buy and actually have a sliver. Granted, when a company's got 10 million shares and you buy one of them, well, it's a small part, but it's still a part. It's still ownership. And with that ownership, you will gain voting rights, capital appreciation. We'll talk about this here, and dividends. So, we buy into a company because we think the company is going somewhere. We're hoping for a good growth and different things like that. But when you're in part of the stocks, you'll get these forms that allow you to vote for the board members and different things like that. You may get invited to special occasions sometimes, different things like that as being an owner. And we'll talk some about mutual funds and ETFs, but I'm going to jump just ahead. Actually, no, I'm not. We'll come back to that. We're going to talk about capital appreciation and dividends here in a moment. Let's talk about mutual funds. Now, mutual funds were very popular back in the 60s, 70s, 80s. We did not have these things called ETFs back then. I'll talk about that in a moment too. So what is a mutual fund? Well, you as an individual could go out and let's say that you want to buy 30 stocks, 30 different companies. Maybe it's AMD, maybe it's some NVIDIA, maybe it's Tesla, Microsoft, whatever. Could be General Electric, General Motors, Ford, all kinds of things. Well, so when you have these investment people, these, it could be a big brokerage firm like your Bank of America's, your Merrill Lynch's, Edward Jones, all this kind of stuff. You've got these big investment firms like that they've got investment specialists, and you can go to, you could go to the said specialist here and say, here's $10,000. And the specialist would say, okay, do you want it to be risky, very conservative, somewhere in the money? What are your goals? Somewhere in the middle, I should say. Different things like that. And then based on that, the investor would go look at a sheet, and his or her firm would have where they have already picked out, let's say, and I'm just going to use 30 as a number. They've already picked out 30 funds, stocks. They've picked out 30 stocks on the theme that lines up with what you talk about. If you're younger and you say, well, I want my accounts to really grow. Well, they've probably picked out 30 stocks that are growth stocks. Now, when you hand them, let's say, your $10,000, you shake hands and sign paperwork and you walk out, then that investment manager would sit down and buy 30 stocks for you. Now, it would all be under the name of a fund name, and let's call it, Get Rich With Me. I don't know. Maybe that was the name of the fund, Get Rich With Me, and you gave them $10,000, and in those Get Rich With Me heading, there were 30 stocks. And so the fund manager would, or somebody in there would buy 30 stocks for you. And which is fine, you didn't have to pay, you didn't have to fuss with it so much. You just walked over there, handed over your check, answered some questions, whatever, and they took care of it. Now, the downside to mutual funds is, let's say that, well, you need some money. And so you go back, maybe you had a big expense come up or whatever, and you go back to the fund manager or to the investment guy and say, listen, I need my money back. Well, then the fund manager or investment guy, lady, whatever, would then have to go in and sell all 30 individual stocks. And when all that was sold and when all that cleared out, then they would give you your check. Well, that could take 2, 3, 4 days in some cases. So there was a lot of work on both sides. Actually, the work was easy on your side. You just gave them the check. The investment person, there was a lot of work on his or her side because of having to buy and sell and all that kind of stuff. Well, people kind of got tired of that, and so then they created ETFs, exchange-traded funds. Now, this one is related, and it evolved from mutual funds. So with an ETF, what we have is we take a mutual fund idea, it's based on 30 stocks, let's say. But we have made a stock out of the mutual fund. Now think about that for a minute. We've made a stock out of the mutual fund. Now what that means is you just simply go in and you buy 1, 2, 3 shares of an ETF, and automatically this ETF has already got this whole mutual fund thing already set up behind the basket. No investment advisor is needed other than to maybe counsel you on, good or bad idea. But if you're interested in getting into like the tech sector, there's one called like XLK. And XLK is made up of 30, 40, 50, 100 different stocks that are all based on technology. And you just go in and you buy shares of XLK, just like you would stocks. And then this fund on the very backside electronically, it's already set up and configured by people that it electronically keeps track of all those 30s, how the winners and the losers and stuff like that. And you have to basically just sit back and you just look at the value of your stock instead of having to figure out everything here based on these mutual funds. Some are up, some are down, this, that, and the other, and blah, blah, blah. The ETF simplifies it by wrapping it all up into one package. So we have stocks, which you just buy a stock in a company. You have mutual funds, which is a basket of stocks. And then you have an ETF, which makes a stock out of a mutual fund. Now, mutual funds are still around, but by and far, most individual traders like you and me are going to deal with stocks and ETFs. You're going to find mutual funds still at the big investment houses like your Merrill Lynch's, your Bank of America's, your A.G. Edwards, and all that kind of stuff. You still find them there. But if you're not going through one of those big houses, it's ETFs. Okay? Now, let's talk about futures versus options. The idea behind futures was to lock in a price for a product to be delivered months later. Now, let me explain. We know that there's volatility because of, and I'm going to pick on, if you've seen the movie Trading Places, that's what it's all about, is about these futures idea. And what happens is that, let's say that you are in the orange juice business. You have to buy oranges. Well, you've got a sneaking suspicion that it's going to be a bad crop of oranges for whatever reason. Maybe it's snowing in Florida. So, well, doggone it, if you wait till later, the cost of a ton of oranges is going to skyrocket. What if you could lock in that price today while it's still low? Now, you're not going to take delivery of those oranges until later, but you can lock in the price today while it's still low, and then if the price of oranges skyrockets, well, you've already got a contract in place saying that you're going to get it at this much lower price, and that's where futures were created, to lock this price in. So, and I'll show you exactly why and how some of these things can be, how these good, bad, disasters, whatever kind of things can happen that really cause the prices to change. At the time that I am making this video, which is April the 3rd of 2024, the price of cocoa has gone up, I think, 300% per ton. And that's just going to throw the cocoa prices skyrocketing. So if you love a good Snickers bar or something like that, you may end up having to pay more for it, that kind of thing. All right, so we get an idea on futures here. We're locking in a price today, but we won't need it until later. Options, on the other hand, give the trader either rights or obligations based on the price movement of the underlying. Now, what is the underlying? Well, that's the stock behind it. So if you buy an option on AMD, then what you're basically saying is the value of this option, and or whether you're in a right to do something or an obligation to do something, depends on the closing price of the option on the day that the option expires. Now, you can intraday trade options as well, and a lot of people like to do that, and they never have any intention of letting this option go to the very end. One thing to realize, both futures and options have an expiration date. At that date, that contract is done. And the outcomes, they say the chips fall where they may. Whatever happens, happens. Now, you can day trade both futures and options, but we'll talk a little bit more about options later on. But understanding you're buying an option, you can buy an option on a stock like AMD, or you can buy an option on a futures even, like oranges, or the S&P, or the NASDAQ, or whatever. Both can be traded for basic price movement, so you don't have to write them out to expiration like I just said. All right. We're coming up to some pictures and different things like that here in a moment. Let's talk about these traditional uses. Stocks, the traditional use was long-term appreciation and or a dividend. The futures, as we just said, we're trying to lock in a price, and options We are expecting some kind of a price movement within a period of time, and we want to use that movement to our favor somehow. So let's take a look at some of that. Here is Meta. And here is the year of 2023 and a little bit into 2024. Back here in roughly January of 2023, Meta was selling for $130 a share. Today, roughly this month, it is selling for $393. That is a 200% gain over a little bit more than a year, about 15 months. Now, I should point out that this is not typical. You know, typically most stocks are going to go up, and they're going to go down, and they go up, and the idea usually is they'll go 2 steps up, 1 down, 2 up, 1 down, or whatever. But the point is that we're looking for the value of the shares of the stock to go up, and we call that stock appreciation. Now, at this point here, you could sell this stock if you wanted to. You would have made a 200% gain. You'll have to deal with the taxes and all that kind of stuff, but we'll call that stock appreciation. I have a good friend of mine that owned about 500 shares of Apple back in the 80s, in the late 80s, early 90s. And at the time, he thought it's not going anywhere. And so he just said, to heck with it. And he sold them. He said if he'd have just parked those, 500 shares or whatever it was, and just forgot about it, locked them in a vault and forgot about them, he would, maybe he spent, maybe like $5,000 on them. He says he would be a multimillionaire today because of stock appreciation over long time. Of course, not all stocks appreciate. Some do collapse. And that's why we really want to look hard at the companies that we put our money in and look to make sure it's a good, strong, solid company and no surprises around the corner, that kind of thing. But that's the idea of stock appreciation. I'm going to buy it and I'm going to sit in it for a while in the hopes that its value will go up. Now, other people will get into stocks because they pay what's called a dividend. So, and actually this was very popular back, in the 50s and the 60s and all that kind of stuff as well, because the idea was if you had let's just say, and I'm just throwing out some numbers, let's say you had $1 million stock. You had $1 million in the Acme Widgets company, worth of stock in the Acme Widgets company. And let's say that they gave a 4% dividend. I know I got a lot of these big numbers over here, but that's, anyway. But let's say they give a 4% dividend. Well, that meant every year they would give you $40,000, 4% of $1 million, because you kept your money you let them hold on to your money for a year. You kept your stock for a year, and so they gave you a dividend, let's say of 4% on $1 million, $40,000. And so it was the goal of many people years back to simply live off of the dividends. They wanted to just build up all their stocks, appreciate it, stuff that account full of money and stocks and stuff like that for companies that paid a good dividend in the hopes that when they got older, and they're in their 50s, 60s, 70s, whatever, that they've shoved so much money in their stock markets there and it's paying dividends that they could live off their dividends and not have to sell their stock. We're going to go back a slide here. You see this stock appreciation here. Well, Meta does not pay much of a dividend. Just simply doesn't. It does pay a little bit, but it doesn't pay a lot. And actually for years and years it didn't pay a dividend at all. I think this year they just started paying a dividend. So if you have this, it doesn't pay a dividend. What do you got to do if you're going to get any money out of it? Well, you have to sell it. But here, we've chosen some stocks that actually pay dividends. And by the way, this was just a scanner just to show me some top performers. Do not take any of this as actual buying recommendations. These are just big performers just to illustrate. There are dividends paying stocks out there or ETFs or whatever that can pay some really big numbers. But that was the whole idea years ago, was to build up dividend yielding stocks. So that was our talking about the stocks. We'll talk now about the futures. Here is, and again, if y'all watch this 20 years from now, this is not probably going to mean anything to you, maybe, I don't know, but in 2023, Russia invaded Ukraine. Well, right here, January, February, March, April, May, June, July, Russian troops were sitting on the border of Ukraine. They're sitting on the border, and they kept telling everybody, no, we're not going to invade Ukraine. We're just here to do some military drills. Yeah, that's it. That's right. Well, if you figured they were going to, Ukraine is big in one thing as an exporter, and that is wheat. Ukraine, at the time that I'm making this recording here, Ukraine is a very, very large exporter of wheat to Europe. Well, if you are, working at some kind of a bread manufacturing company in Europe and you depend on getting your wheat from the Ukraine, you very well might buy a futures contract here for $800 or 800 times the multiplier or whatever that is, to lock in this price at 800. Because what happened 2 months later? Russia did in fact invade Ukraine, and look where the price went. It went as high as, over $1,300. But if you'd bought your futures contract back here, you have locked that price in. You may not take possession of it for a year from now, but you have locked in a price on that wheat at 800, even if you don't even take possession of it for a year. Versus some of these people here who bought it. Now, some people may also be day trading it in here, where they bought it going up and then they sold it coming down. But the last thing you want to be is, the bread maker guy needing that wheat and realizing that you're going to have to pay $1,200 to get it, when you had the opportunity to get it at 800. And that's why futures originally came around. Not necessarily for conflicts and stuff like that. It could be for anything. It could be oranges because of seasons. Do we expect a rainy season, a dry season, snow or whatever, that kind of thing there based on the weather. Different reasons that you may want to lock in a price. Another reason to lock in a price is for your accounting purposes, so you know what your expenses are going to be. And so that's another idea of futures. Now, today, many people day trade futures, and they're in, they're out, they're in, they're out. They may be trading gold, they may be trading silver, they may trade oil, they may trade the indexes like the S&P 500 or the NASDAQ. There's all kinds of different ways, the Russell 2000 and so on. All right. Now, options, and I'm going to go ahead and tell you now that options are by far the most complicated of all of them. And of all the different things here between stocks and futures and options. Options have got a slew of moving parts in it. If you think of trading stocks and futures as like playing tic-tac-toe, well, then I can promise you that learning options is like playing 3D chess from Star Trek. They're just completely different things. Because you can trade an option bullishly. You think it's going to go long, and you can buy an option bullish. You can also, if you think, you can also trade them bearishly. You can also trade them neutral. Let's say if you think the price is just going to stay in a channel, there's a trading strategy in options called an iron condor, and it means it's going nowhere, but I'm going to make a lot of money as long as it goes nowhere. You can do that in options. There's even a strategy called a straddle that you think it's going to break out, but you don't know which way. There's an option set up for that. Sometimes you can use an option just because you want to get a better price on a stock. And there's this popular trading strategy out there called the wheel. And its idea is there is for you to get a better price on stocks by getting a premium, getting paid up front to take a bet that the price on that stock is actually going to fall. And if it does fall, not only did you get to keep your money in the bet, premium as we call it, but you also got the stock at the lower price. Many people use them as a hedge, and you can certainly do that because maybe you have got a lot of stock in this company, the Acme Widget Company. You're concerned, though, that maybe earnings is coming up, and you're concerned that it's going to be a bad report and the price is just going to just crash. And so you can actually use an option to provide a little buffer, spend a little bit of money to buy some insurance on the downside. That's called a hedge. You can day trade them. You can be in an option for over a year. They have different times and lengths and different things like that. As you can see, there's a lot of combinations you can do here. And so they're a lot more complicated. As a general rule, I would tell people, if you do not know how to trade just the charts of stocks or futures, not saying that you have to, but you should be able to look at a stock price, a chart. If you cannot trade the charts based on price action, or some combination maybe of indicators or whatever, if you don't have a successful strategy with that, then do not get into options. Because if you can't do normal trading, you will lose on options in most cases. Because it's part of the formula with options is knowing how to trade the actual stock. All right. We'll talk about complexity. And then I'm going to break this up into 30-minute, roughly, little chunks here so they're easier to digest. Complexity. Stocks are by far the simplest. If the Acme Widget Company is going for $30 a share, you buy a share, you paid $30 for it. If it goes up $1, you made $1. It's that simple. The futures are not the simplest because you do have to figure out a little bit, add on this concept of contracts and stuff. But it is basically stocks with the idea of contracts, and there are details about the contract. So a little bit more complicated, not terrible by any means. Options have a tremendous learning curve on them at the beginning. They can be very profitable, but if you want to talk about this being your bachelor's degree, here's your master's degree, here's your PhD over here. That's the way I would look at it. All right. This, for example, is options. This blue line here, this is what's called an iron condor, and the idea is that as long as the price stays in this region between here and here, as long as the price stays between these two, you're getting paid a premium so long as it stays in that area, and you get to keep it. As long as it stays in that area for the time of how long you told the option to run. But if the stock price starts to come lower or higher, then you start reaching a point that you're not going to get to keep as much premium, and there comes a point even where you're actually going to have to, you may actually have to pay more because you're on the wrong end of a losing trade. You actually could have to pay back plus more because of the way you're in the trade. Options involve things like days, an expiration, like at the time I do this video here or whatever. 3 days left on this contract. You have to keep up with delta and theta. You've got a bid and an ask on it. You have to pick a price of, whatever this stock is. Yeah, I think it was AMD. At the time that I took this picture, it was trading somewhere around $177.50. And when you design your option, you've got to say, well, I want to base my strike on $185 or $165. So you've got expiration, deltas, thetas, bid asks, strike prices. There's a lot more to options. And like I say, I'm just telling you up front, you can do great with options, but until you can do regular stock trading, I advise you not to get into the world of options. All right. Let's see. Let's talk a little bit about risk, and then we will let's see what, yeah. So let's wrap up with risk. Risk. This is kind of a long topic, sort of, kind of, so I'm going to call this the last topic for part one. So risk, part one, or whatever. Y'all know what I mean. Stocks. If you buy 10 shares in the Acme Widget Company, and those 10 shares are going for $30 a piece, you spent $300. How much can you lose? If Acme Widgets Company goes bankrupt tomorrow, you lost $300. Whatever you put in it, that's what you lost. That's the most you can lose. You can't lose a dime more. You cannot lose a dime more. So, okay, that's good. Options depends on which side you're playing. If you are buying long, if you buy an option, that option will cost you a lot less money. We'll talk about that later. But if your option goes wrong against you, you can't lose anything more than you put in it. So if you put $50 into an option and you bought the option, notice I said buy the option. If you bought the option for $50 and the trade just completely falls apart, nothing goes your way, you're out $50. However, if you sell an option, then without some kind of coverage protection, and there's ways to build a risk-limited option, but if you sell an option, you can have actually an infinite loss. Because a stock, let's say that you were, say you sold an option, basically you're gambling that the price of the stock, the Acme Widgets Company at $30, is not going to go up. That's your bet. It's not going to go up. It's not going to break $30. And then it goes up to $50, $60, $70. You think I'm crazy? Well, go look at NVIDIA this year. It went up from around $250 to $900 in 1 year. Well, wait a minute. All of a sudden now, you say, well, because of the way you set up the option, what you said was, I will take your shares at, if the stock does go above $30, I'll sell you my stock. I don't actually have the stock, but if it goes above $30, I'll buy the shares for you. Well, what if it goes to 100? Well, now you got to buy this person 100 shares at $100. That's why we say that options actually can have, depending on how you do it. Futures can be infinite as well, because futures are a little bit different. When you enter the futures, you enter into the middle of what's already trading, and you don't actually buy necessarily. You can buy, of course. We do buy and sell. Let me change that word I just said there. We do buy and sell. But you have what's called a margin account. And that margin is your right to trade the futures. That's your collateral that you put up to get into the futures market. So let's say that your account has $10,000 in it. Let's say that you think that the S&P is going long, and so you buy long contracts in the S&P, the ES. And let's say that now, in the case of the ES, each point that it moves is worth $50. Well, let's take a look at that. Here we are. Well, you have an account of $10,000. If the S&P drops by 200 points, which can happen over a series of a couple days, if you don't get out of that trade, your account is zero right now, because you had $10,000 in your account, you took a contract, it went the wrong way, and you're now down to 200, and that 200-point move times $50 a point, 10,000. You're wiped out. Here's the problem. What happens if you have $10,000 in your account and it drops by enough points that you're actually down 5,000? You're in the hole 5,000. Can you do that with futures? Yes, you can. That's what we call a margin call. That's when your broker calls you up on the phone and says, hey, Fred, or hey, Samantha, listen, you owe us, not only is your account wiped out, but you need to send us $5,000 more. Now, there are ways to help. That's called a margin call. That's when your broker calls you about that you owe them money. There are ways to set up your trade to minimize the risk on these kind of things. Futures, a lot of people get really scared and intimidated about futures, and the reality of it is that you'd have to have what we call just a basic crash of the market. You'd have to have basically a crash of the market for you to really get into a bad spot. Some brokers will automatically close your account right on the spot if they think you're in danger. Some brokers will not, and you need to know this about your broker. For example, Trade-O-Vate, if you get down, like if you got $10,000 in your account and your trades are going against you, if you get down to where you're going to have less than about $500 in your account, they will shut it down for you automatically. That's one way. And of course, prudently, I would recommend that you, when you go into a trade on any of these, that you use stops. So that would be at least 2 levels, your stop plus your broker's stop, or liquidation, there to keep you from actually going negative. But not all brokers are that way. TD Ameritrade and some of those others, or Schwab kind of thing, depending on your agreements with them, may let you go negative. That just depends on your arrangement with them. So, at any rate, all right, so there we've covered what they are, traditional use, complexity, and risk. And of course, if you have any questions, feel free to reach out to any the moderators or myself on the Bullish Bears platform. And as you can see, we've got quite a bit more to go here. That's why we're breaking this up into little small chunkettes, or whatever you want to call it. So, all right, we're going to pick up on upfront capital in the next video. Thanks.